Good morning. This is Tom Alexander. It is Sunday, May 28th. It is almost 11 a.m. Eastern Time in beautiful Charleston, South Carolina. This is the weekly video addendum to the written report you all should have received. If you are finding me on YouTube and you did not receive that report and you would like to receive it, just send me an email to tom@alexandertrading.com. and I will happily put you on the list and you will get the free report each week and notifications. Also, if you find value in this video, I would very much appreciate it if you would like it, if you would subscribe to the channel, and please feel free to make comments, ask questions. I'm happy to answer and respond to any and all comments and questions. Okay, the stock indices. Okay, I've been trading for 38 years and I have traded through many bull and bear cycles. And I've also studied market history. And I am unaware of any bull market or any bear market in which you have the different sectors of the market. And in this particular instance, the major sectors in the US market are the SPX, the NDX, the Dow, and of course the Russell. Those are the four primary US trading indices. Now there's sectors within those, I realize that. But those are the four primary indices in the US, trading indices. I have never seen, and I'm unaware of any bull market or bear market when they are not, for the most part, in sync. You will have minor divergences at short-term pivot highs and lows within bull trends and bear trends among and between the indices. That's not unusual. As a matter of fact, that's quite common. But what you don't have is a persistent continual divergence and extraordinary outperformance among and between the indices. And in this particular instance, the obvious situation like that at this time is the incredible outperformance of the NDX and the Russell. Something has to give here. Now, for me, speaking for me, I use price action to make trade decisions. And when I'm trading the stock index or stock indices, stock index futures, ETFs, any of the derivatives around the stock indices, one of the things that I don't use indicators, I use price action, but I depend very heavily on reading the price action among and between the indices. So this has been a difficult time for me. The past 2 months have been, for me, as difficult a time as I've had in many years trading, because the disparity of the price action. So what I have found, and I think this is what I'm doing now, and it's what I suggest you do. I think you have to take each index on its own, because the auction market process is in effect in all four of the indices. It's just that it's different. It's so different. The indices are in such different structure and phases of development. And again, the example of that, the most striking example of that right now, is the difference between the NDX and the Russell. The NDX is clearly in a trend. It is in an initiative phase of development. On the other hand, the Russell is in a multi-month balance area. It is balancing. It's not trending. And something has to give here between those two forces. Now, I want to warn people that, and this is note to self, it's very easy to look at this, and I have been bearish most of the past 2 months because of this incredible lack of internal momentum in the broad market. That generally is not a good thing. Now, that's a divergence. It can resolve one of two ways. We can have, we're either in the process of forming some sort of top of relative significance, or this market, the broad market, is getting ready to explode to the upside. And don't think it can't happen. You know, this is when price action can really save you. I know there's all sorts of noise. The political backdrop is just, it is what it is, and it gets noisier and noisier and noisier. So they're all, you can name all these exogenous reasons and attributions and guesses and pin that on price action. But ultimately, you're better off just following price action. So what I want to do today, I want to go through each of the indices individually, and we'll discuss where they are individually. So let me show my screen. Okay, here are the 4 primary U.S. trading indices. Let's start with the NDX. The NDX is in clear vertical development. Now, it closed Friday at the upper cusp of a level that I've had highlighted for several weeks. You can go back and you can look at previous weekly reports. Just click on it. They're on the website. It's free. Just click on it. And you can see this is a level that I've had highlighted. Now, do I expect this market to stop on a dime? No, it shouldn't. From an auction market perspective, this is extraordinary momentum, and it would be extremely bearish now if the NDX were to turn around on a dime and close below Friday session low. That would be unequivocally bearish, at least short term. The next level above here is up here, this the low 15,000s, 15,115 to 15,271, and that is the area of the high over a year ago. So this is a market. If this were the U.S. stock market combined, this is a very, very bullish look. The market is making, the NDX is making higher highs and higher lows in all time frames, and it looks like it's actually picking up momentum. Now, is it going to continue at this rate of change? No, it is not. I can say that unequivocally. It's not going to continue at this rate of change. It is likely to balance, even if we're in the next great bull market. It is very likely to balance somewhere beginning relatively soon before it gets to this level. Okay, let's look at the S&P, the SPX. So the SPX has been flirting with this 4,200 level. It cannot get through. It has been unable to get through it. It tested it here. You could call this a test. 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 Now, we did close above it on Friday, barely, but not with any sort of conviction yet. The next level above here is this area around 4,300. To the downside is last week's lows. So we'll see. This is going to be an interesting situation. Now we're in a 3-day weekend. There's futures trading that begins tonight, Sunday night. And then the cash market doesn't begin trading until Tuesday. So it will be Tuesday before I trust anything that happens in Globex tonight or in the funky Globex session that carries into Monday morning. So this is where we are in the S&P. We're right at, we closed right above a critical inflection point. So there's going to be, from an auction market perspective, what this is telling you is there's going to be a sharp move away from here very, very soon. I'm not going to spend a lot of time on the Dow. I'll just show the Dow. The Dow is making lower lows and lower highs. It is a long way from this year's high on a relative basis. And I'll just leave it at that because it's the most narrow of the indices. And to me, I'm not interested in really following it right now. Okay. This to me is the most interesting of the 4 primary U.S. trading indices. This market has been in balance since this was the proverbial stopping price from an auction market perspective. Those you market profile aficionados know Stottlemyre posited this 4-step process. It's really a 3-step process, but that's neither here nor there. You have a trend, you have a stopping price, you have development around that price, then you have a breakout, and the process begins again. Well, the process, this was a trend. This was the stopping price. We've developed around that price. And you can see Friday, we closed almost exactly at the same level that we closed at back in March. middle of March. So the break of this, and this reflects the internals of the market. This reflects breadth, and we're going to talk about breadth in just a minute. But unless you see the Russell close above this level, and then you see momentum continue to pick up, and you see the retracement relatively shallow, this is what has been so created so much cognitive dissonance, at least for me as a trader, watching the NDX go up day after day, and then the NQ cannot get out of its own way. But it is what it is. Again, let's just take each one individually, and this is in balance. This is clearly in balance. You want to respect a break above this 1816 level. This is last week's low. That would be a warning. You know, the Russell, if we're going to break out here in a big way, the Russell should immediately begin to trade higher, frankly. Okay, let's look at the some technicals on the market. Now, I use New York Stock Exchange data, specifically breadth, advancing issues, declining issues. The red line down here is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of advancing issues. And you can see how coiled up, how tepid breadth has been for months. Now, this is something that is going to change. This has been this perfectly reflects the price action of the past 2 months, and there is a lot of room for expansion here. If the market does break out above this 4,200 level, and the Russell begins to show some strength, it's going to be reflected in breadth. And the message here is breadth has a long way to run. Breadth can go a lot, can expand dramatically here. From where it is. And if that occurs, we're going to see 4,300 in a heartbeat, and probably much higher prices. And it would be suggestive of, you know, a new bull market underway. Now, VIX. Let's take a quick look at VIX. And VIX has been unable to sustain any momentum above 20. It's hovering around, you know, it did pick up last week somewhat, but it's, you know, the market is not going to decline much or far with the VIX below 20. Okay, and I will leave you with this view. This is a 30-minute view of the SPX. So this is obviously cash market hours. This is breadth below it. And you can see we had this big ramp off the low on Wednesday. Breadth has been very, very weak in that ramp. That's unusual for a kickoff move. If next week we see a breakout above 4,200, we see the Russell begin to show strength. What I think you will see, what I strongly think you will see, is a massive immediate expansion in breadth. So that's something to be watching for when the market opens on Tuesday, that first hour or so. If this is a legitimate breakout, you should see breadth probably 2,000 plus and staying there all day. And if you see that, you do not want to be fading this market. Guys, enjoy the rest of your long weekend. I'll speak with you again soon.